Hey everyone, welcome back to the channel. Today, we're diving deep into a topic that impacts every single one of us in the UK, interest rates. The Bank of England has held interest rates steady at 4%. And while that may sound like good news on the surface, we need to unpack what this really means for our wallets and our economies. So let's get right into it. The Bank of England is trying to tackle inflation, which is still well above its target of 2%. We're talking about an inflation rate hovering around 3.8%, almost double what the bank aims for. Now, what does that mean for you? It means that as prices rise, your purchasing power diminishes. The cost of living is on the up, and we can feel it in our pockets, especially when we look at food prices, which are climbing even higher than the general inflation rate. This is crucial because if inflation stays elevated, it can put pressure on the bank to increase interest rates to cool down spending. Interest rates are essentially the price of borrowing money and the reward for saving it. They dictate how much you pay on mortgages, credit cards, and loans, and trust me, they have a ripple effect across the entire economy. The current base rate influences how banks set their own rates for loans and savings accounts. If you've got a mortgage that tracks the bank's rate, you're feeling the sting right now. With average mortgage rates hovering around 4.98% for 2-year fixed deals and slightly higher for 5-year ones, many homeowners are facing much steeper costs compared to a few years ago. And here's where it gets interesting. About 800,000 fixed-rate mortgages with interest rates of 3% or below are set to expire each year until 2027. That's a lot of people who will be transitioning to significantly higher borrowing costs. If you think about it, this is a ticking time bomb for household budgets across the nation. As those fixed deals run out and homeowners move to new rates, we could see a wave of financial strain. Now let's talk about credit cards and personal loans. Interest rates from the Bank of England also trickle down into these areas. When the bank holds steady at 4%, lenders often take their sweet time adjusting their rates. So even though borrowing costs could be cheaper if the bank cuts rates, don't hold your breath waiting for lenders to lower their rates swiftly. It's more like watching paint dry. But it's not all doom and gloom. If you're one of those savvy savers out there, you might be thinking about how this affects your savings account as well. A falling base rate typically means lower returns on your savings. So if you're relying on that interest income to supplement your lifestyle or get by in retirement, keep a close eye on those trends. And let's not forget the bigger picture here. The global economy plays a significant role in how our domestic policies unfold. With uncertainty stemming from geopolitical conflicts like those in Ukraine and Israel, or unpredictable US tariffs looming overhead, it makes decision-making at the bank more complex. As we approach Chancellor Rachel Reeves's upcoming budget announcement, all eyes will be on potential public spending measures aimed at stabilizing our finances. The government is under pressure to act, especially as public health officials raise alarms about child poverty affecting thousands of families. So what does this all boil down to? The next few months will be critical as we await more economic data that could sway future interest rate decisions. The bank has indicated that any cuts will need to be gradual and careful, and this means we should brace ourselves for more fluctuations ahead. In conclusion, whether you're a homeowner, renter, saver, or borrower, understanding these dynamics is crucial for navigating your financial future. Keep an eye on those interest rates. They affect us all. If you found this video insightful, make sure to hit that like button and subscribe for more updates on economic trends that shape our lives. Until next time.